So, good morning or good afternoon, dear ladies and gentlemen. It is my sincere pleasure to welcome you to today's webinar. Effective 1 January 2024, the Malaysian government has implemented capital gains tax, or CGT for short, in Malaysia. The introduction of CGT not only increases the country's revenue collection, but also seeks to minimize the gaps between the different income groups by ensuring fair treatment between taxation of business profits and capital gains. In the course of this webinar, my dear colleagues Chiu Yen Lim, Kartika, Rosita, and Priya Selvanathan will highlight the key concepts on CGT for you. Though quite a few of you will probably already be more than familiar with the technical side of virtual meetings, let me quickly guide you through this. In the top right corner of your screen, you will find the control panel. Here you may adjust the audio settings and choose between your headset or the computer audio. Please note that as an attendee, you are muted by default. A little further down on the dashboard, you will find the question panel. Please insert all your questions or comments here for us to take care of. You may do so anytime during the session and refer to topical questions for sure, as well as to any technical hiccups that might occur, though of course we hope they won't. We will note all your questions and attend to them in the Q&A session at the end, while I will of course attend to any technical issue immediately. Please note that we will record this webinar and make it available online for you and your colleagues to recap anytime you wish. You will receive an automated email through GoTo after the session, providing you with a corresponding link. Looking forward to a most enlightening session. I will now gladly leave the stage to my dear colleague, Yen. Yen, the stage is yours.
Thank you, Bettina. Good afternoon and good
Yen, I'm sorry, we have an audio problem on your end.
My name is Yen. I'm a tax manager.
We have a technical problem on your end. Maybe you can just quickly check on this.
Partner Malaysia. So yeah, today we'll be covering
And so we can't hear that now. I'm sorry, Yen, but it seems you are frozen right now. We lost connection. Kartika, Priya, maybe somebody of you could take over until Yen settled the technical issues on her end. Thank you.
Hi. All right. Yeah, so for today, these are the agenda that we will be presenting about the capital gains tax in Malaysia. So we will discuss about the overview, the disposal of capital asset deemed derived from Malaysia, impact on RPGT, disposal and date of disposal, computation of CGT, CGT exemptions, double tax agreement, and the last session is the Q&A sessions. Okay, I think Yen will discuss about the overview until the impact on RPGT, and I will discuss regarding the disposal until the CGT exemptions. And last but not the least, Priya will be talking about the double tax agreement. Maybe if Yen is ready, then I can hand over to Yen.
Can you hear me?
Yes, so we can hear you. It's good to have you back. No, not really. It's still feeble.
Can you see me?
We can see you, yes. but the connection is too weak. You get frozen. Maybe Yen, we can try to switch off your video and just stick to the audio. Maybe that will work.
Okay, is it better now?
Yes, it is for the moment.
Yeah, can you hear me?
Yes, we can hear you.
Can you hear me?
Yes, we can hear you.
Okay. All right. Is it good now? Yeah. Okay.
Yes, you're perfectly understandable now. That works pretty fine. Thank you very much. Yen, did we lose you again? It seems we have a major issue. Yeah, you are? Are you ready to go, Yen? Okay. I'm sorry. It seems we have lost Yen for the time being, so I still have to ask Kartika or Priya if one of you may somehow start with Yen's part of.
Okay,
Here you
I
are.
continue?
Yes, sure. If you are ready, we are. We can't hear you at the moment, Yen. I'm sorry. Yen, if you can hear me, you might want to just leave the session and get back in. That might, if we are lucky enough, solve the issue. And in the meantime, I'd ask Kartika or Priya to just help a little bit and start with these first slides for our audience. That would be great.
Okay, Rosita, I'll take over.
Thank you very much. Thank you.
Okay,
Yeah.
so okay, Yen, you're back. Maybe you can go ahead, Yen.
There seems to be a major issue on Yen's end. Like I suggested, maybe Yen, you might want to leave the session for a moment and just get back in. Sometimes this helps to solve the issue. So we will continue.
Bettina, yeah, I'm on.
Yeah, you on? Okay, great.
Bettina?
Yes.
Yeah. Okay, is it smooth
Great.
now?
Yes. We're ready. Yes.
Okay, all right. Sorry about that. Yeah, I think it should work now. Okay, yeah, let me continue.
Sure,
Okay.
sure.
I hope it's all good now. Yeah. Okay. Just to share a bit of a background about capital gains tax in Malaysia. So previously, there were no capital gains tax in Malaysia. We only have income tax, and the only capital gains that is taxed in Malaysia is the real property gains tax in Malaysia. And the reason Malaysia moved to implement this CGT in Malaysia is a result of Malaysia being placed in the European Union Code of Conduct under the grey list, which Singapore and Hong Kong was also in the grey list. So resulting from that, Malaysia, Singapore, and Hong Kong implemented this capital gains tax effective 1st of January 2024. So let me just share what is the overview of capital gains tax. So capital gains tax is chargeable only on these 4 categories of taxpayers, which are the company, limited liability partnership, trust body, and cooperative society. The government has mentioned in a media release that trust body is actually exempted from CGT from 1st of January 2024 until 31st December 2028, but this is still pending the legislation from the government. And then next, what is subject to CGT? So CGT is only upon any disposal of capital assets. And disposal here, we means any sale, convey, transfer, assign, settle, or alienate, whether by agreement or by force, includes a reduction of share capital and purchase of a company of its own shares. So this include share reduction, and also, any form of sale of purchase of shares. And capital assets is also defined in the Act that covers movable or immovable property outside Malaysia, which includes the rights and interests as well. And also movable property for capital assets in Malaysia, it's only relating to movable property in Malaysia, which is a share of a company incorporated in Malaysia and not listed on the stock exchange. In short, it is those sale of unlisted shares in Malaysia. So CGT, like I mentioned, it's effective 1st of January for all disposal of capital assets, but there was an exemption given by the government for domestic assets for 2 months, which is January and February. So CGT on domestic assets is only effective from 1st of March. I will cover more in detail what I mean by foreign assets and domestic assets in the next slide. Next slide, please, Bettina. Yeah. So for CGT, we have actually separated it into 2, which is domestic source and foreign source. So like I mentioned earlier, the capital assets which is subject to CGT for domestic source are disposal of unlisted shares for companies incorporated in Malaysia, and also disposal of shares of a foreign company deriving more than 75% of their value from real property. In short, this is what we call the Section 15C shares, which are deemed derived from Malaysia. As for foreign source, the capital assets which are subject to CGT are all capital assets, which I mentioned earlier. It will be any immovable or movable properties located outside Malaysia, including the shares as well. And the tax rate for domestic source is 10% of the net gain. But for any assets acquired prior to 1st of January 2024, the taxpayer can choose to either pay 2% of the gross disposal consideration or 10% of the net gain, whichever that's lower, of course. And for foreign source, the tax rate will be the prevailing corporate income tax rate. For example, it will be 24% for non-small and medium enterprise companies. So when is CGT required to be reported? For domestic source, it will be 60 days from the date of disposal. My colleague Kartika will go through in detail what are the date of disposal to determine the date of disposal. And for foreign source, it will be when the income is being remitted into Malaysia. And for the mechanism, how do you report the CGT? There will be for domestic source, there will be a separate CGT return, and it must be filed within 60 days from the date of disposal. And as for foreign source, it will form part of the annual corporate income tax return as and when you file the annual return. Of course, there are exemptions available for domestic and foreign source. For domestic source, the exemptions will be on internal restructuring, approved IPO, and venture capital companies. As for foreign source, it will be subject to economic substance requirement if you fulfill these requirements, which is to employ an adequate number of employees in Malaysia and also incur adequate amount of operating expenditure in Malaysia. Then it will be exempted from CGT. So this is an overview of the CGT for domestic and foreign source. All right. Next, we will go through some case studies on the scope of CGT. All right. So here are a few examples. So for example, we have A. Sdn Bhd, which is a company incorporated in Malaysia, where A disposes the shares in B. Sdn Bhd. So this is the disposal of shares of unlisted company in Malaysia. So this is a domestic source CGT. Okay. So for the second one, C. Sdn Bhd, a company incorporated in Malaysia, disposes its shares in D, which is a foreign company, incorporated outside Malaysia. So in this case, CGT will be applicable as well under the foreign source CGT because it disposes the shares in a company outside Malaysia. The next example, so if let's say we have E, which is a company incorporated outside Malaysia and disposes its shares in F. Sdn Bhd, which is a company inside Malaysia, so this will be a domestic source CGT. So regardless whether the company, the disposer here, whether it's a Malaysian or foreign incorporated company, it will be subject to CGT as well, so long as there is a sale of shares in an unlisted company in Malaysia. Okay, next slide, please. Okay, so if let's say I have a company, A. Sdn Bhd, which owns real property in Malaysia, so this is not covered under the scope of CGT. Because CGT, like I mentioned, for domestic source is only on unlisted shares in Malaysia and also Section 15C shares. So if there is any disposal of real property in Malaysia, this will be subject to real property gains tax and not covered under CGT. Whereas if we have another company, C. Sdn Bhd, which owns real property outside Malaysia, then any disposal of real property outside Malaysia, it will be subject to CGT in Malaysia under the foreign source capital assets. Okay, these are just some of the simple illustrations on what is covered under the Malaysian scope CGT. Okay, next I will cover on disposal of capital assets deemed to be derived from Malaysia. Okay, and this is what we call Section 15C shares. So under Section 15C, it says that any gains or profits accruing to a company, limited liability partnership, trust body, or cooperative society, which is the 4 types of taxpayer that I mentioned earlier. So if there is any gains or profit from the disposal of a capital asset, which is a share of a controlled company incorporated outside Malaysia, it says that it will be deemed to be derived from Malaysia where the relevant company owns real property situated in Malaysia or shares of another company or both. So there are a lot of words here, but later we will just go through some example to understand what is this Section 15C about. So here it says the disposer, which is the 4 group of taxpayer, company, limited liability partnership, trust body, or cooperative society. And whenever they dispose any capital assets, which specifically is the share of a controlled company incorporated outside Malaysia, and if this company derive more than 75% of its defined value from Malaysian real property or shares in another controlled company with 75% of its value from Malaysian real property or both. So if any company disposes any shares in a company incorporated outside Malaysia, under this scenario, it will be deemed to be derived from Malaysia and hence subject to CGT. So what is this all about? Next slide, please. Okay, so now we will just go through some example of Section 15C shares. So let's say if we look at the diagram, disposer, we have a disposer who disposes of its shares in a foreign controlled company, which owns real property in Malaysia and also other tangible assets. And the real property in Malaysia, the defined value is more than 75% of its total tangible assets. So in this case, the disposal of shares in the foreign controlled company will be deemed to be derived from Malaysia and will be deemed to be a Malaysian source CGT. Okay, next slide, please. Okay, another example here. So if let's say a disposer disposes of its shares in foreign controlled company, which owns shares in another company, which owns real property in Malaysia. Okay, so if we look at the diagram, so foreign controlled company owns the shares in real PropCo, and at the same time, it has other tangible assets. And PropCo also owns real property in Malaysia and other tangible assets. So now here we need to see the test whether it fulfills the 75% rule. So under test number 1, PropCo owns real property in Malaysia, which has more than 75% defined value out of its total tangible asset. So this is test 1 that we need to pass. And if that is true, then we look at test 2, whether the defined value of the shares the shares in PropCo, whether it fulfills the 75% rule. So if the shares in PropCo is more than 75%, so the disposal of shares in foreign controlled company is also deemed to be a Malaysian source disposal and subject to CGT in Malaysia as well. All right, next slide. Okay, so in this case, where the foreign controlled company owns real property, which is the first, the most left one. So it owns a real property. At the same time, it also owns shares in PropCo. So this is actually like a combination of case study, our first example, case study 3 and case study 4. So it's a combination. So it owns real property. At the same time, it also owns shares in PropCo. And if the defined value of this whole thing, which is the dotted line, the box in the dotted line, if it's more than 75%, if it exceeds 75% of the defined value, so the disposal of shares in foreign controlled company will be deemed to be a Malaysian source capital asset and also subject to CGT in Malaysia. So this is a simple illustration on how Section 15C shares work, and any disposal of shares in foreign company will be deemed to be a Malaysian source and subject to CGT in Malaysia. Okay, next slide. Okay, so this is just a brief overview of how, with the implementation of CGT, impacts our real property gains tax in Malaysia. Because like I mentioned earlier, Malaysia used to only have real property gains tax, which are only taxed on real property and shares. In this case, the real property must be situated in Malaysia, including any interest, option, or right over such land. And for shares, it's only on shares in real property company, and also para 331B shares, which is the transfer of assets between controlled companies, and loan stocks, debentures, and etc. So previously, if there's any disposal on this real property of shares, like I mentioned earlier, it's only subject to RPGT. So with the introduction of CGT, any disposal of shares in companies listed in Malaysia, companies not listed in Malaysia will be subject to CGT. So there's actually no double taxation. real property gains tax will still be subject to tax for those covered under the scope of RPGT. All right. So just a simple illustration to show how RPGT and CGT works in the next slide. Okay, this is to show that there is a paragraph in the Real Property Gains Tax Act which specifically exempts that if there is any disposal of shares for the four group of taxpayer, company, limited liability partnership, trust body or cooperative society, other than a loved one entity, will be subject to CGT and they will not be subject to RPGT. So RPGT and CGT is actually mutually exclusive. So you will only be taxed once. Okay, next slide. Okay, so this is an example. We have X Sdn Bhd, which owns real property, and X Sdn Bhd has two shareholders, which is Mr. A, in this case is an individual, and also Alpha Sdn Bhd, which is a company incorporated Malaysia. So X Sdn Bhd, being the owner of the real property, will be a RPC company as defined under para 34A of the RPGT Act. Okay, and Mr. A and Alpha are the shareholders of X Sdn Bhd. So during the year 2025, Mr. A and Alpha disposes their shareholding in X Sdn Bhd. So in this case, when Mr. A and Alpha Sdn Bhd disposes its shares in X Sdn Bhd, will it be subject to RPGT or CGT? So like I mentioned earlier, CGT is only subject to CGT is only taxed on the four types of taxpayers, which are companies, limited liability partnership, trust body, and cooperative society. So CGT is not applicable to individuals. So in this case, Mr. A, whenever he disposes its shares in X Sdn Bhd, any gain made by Mr. A will be subject to RPGT. Because X Sdn Bhd is a RPC, which is a real property company. On the other hand, Alpha Sdn Bhd, which is a company incorporated in Malaysia, will be subject to CGT on any gains it made on the disposal of X Sdn Bhd. So this is just a simple example on how RPGT and CGT works, and there will be no double taxation in this case. Next on, I will pass it on to my colleague Kartika, who will continue the presentation on the disposals.
Thank you, Yen. So just a little bit of recap. So what is CGT, right? CGT is the gains or profit from the disposal of capital asset. So I will be discussing about what is the meaning by disposal here. Okay. According to the section 65C of the law, disposal means to sell, convey, transfer, align, settle or alienate, whether by agreement or by force of law, and includes a reduction of share capital and purchase of a company of its own shares. So there's a lot of words here, but what I want to emphasize is that if you see the definition, it mentions a word includes these two transactions, a reduction of share capital and a purchase of a company on its own shares. So it means that whether these transactions are limited to these two, or it will be other transactions that will be included under the ambit of disposal. I think there will be like clarifications from IRB in regarding to the meaning of the disposal. So why actually the disposal is important here, as Yen mentions in the earlier slide. So for domestic CGT, you have to file your CGT return. It's in the prescribed form within 60 days from the date of the disposal, right? So what is the date of disposal? The date of disposal is the date of the written agreement, or if there is no agreement, is the date of completions of the disposal. So the date of completion of a disposal is the date on which the ownership of share is transferred, or the date when you receive the consideration of the transfer, meaning the money or the monetary value that you receive, whichever is earlier, right? We are going to the next slide. I'll be showing the case study for disposal. In scenario 1, Cempaka Sdn Bhd entered into a written agreement with Mawar Sdn Bhd on 2nd of October 2024 to sell shares in Rimba Sdn Bhd for considerations of 3 million ringgit. The shares were transferred to Mawar on 2nd of December 2024, meaning 2 months after the written agreement, right? And Mawar will make a full payment on the same day. So first thing first that we want to see here is there any written agreement or not, right? So it is stated in the first bullet that there is a written agreement, which is dated 2nd of October 2024. So it's easy that, okay, the date of disposal is the date of the written agreement, which is 2nd of October 2024. So in scenario 2, there was no written agreement between Cempaka and Mawar. So we need to see the completions of the transfer. So in this case, Cempaka bank statement shows that the full payment received on 2nd of December 2024, and the letter of transfer of ownership, it takes time. So it is dated 3rd of January 2025, which is a month after that. So we need to choose which one is the earlier date, when was the money received. So the money received is in the bank statement is on the 2nd of December, which is earlier than the date of the transfer of the ownership. So in this case, the date of disposal will be on the 2nd of December, which is when you receive the consideration amount. Okay, next slide, please. So earlier is the essence of the date of disposal, but in this diagram, you will see like if there is a written agreement and there are certain conditions, right? So if you see number 1, first thing first, we need to see is there any existence of the written agreement or not. So if it is a no, then you go to number 2, the date of completion of disposal, whichever is earlier, which is the date when you transfer the ownership or the receipt of the whole consideration, whichever earlier. But if there is a written agreement, you need to see whether the contract is a conditional contract or not. If no, then it's simple. It's just a date of the agreement. So in the earlier case, we just take an assumption that there is no conditions in terms of the contracts, and we just take the date of the agreement. So if the contract is conditional, and then it will go to the federal government or state government approval required, then we need to see whether such approval by the government is conditional or not. If it is conditional, then we need to, the date of disposal is the date when all the conditions are satisfied. But if there are no other conditions other than the government approval, it's only the date of the government approval itself, which is in the middle box. But if there is no federal state government approval, then you go to the left box, which is on the date of agreements. Yeah, it's just as simple as that. Okay, next slide, please. Okay, here's a lot of formula here. So this is important, how to compute CGT. I will not discuss into details in terms of how the formula works and examples, because I think it will take a lot of time. So what you just need to remember is how to compute CGT is disposal price minus acquisitions price. So what do you mean by disposal price, right? It's the money or cash value for the considerations for the disposal of capital asset after deducting related expenses. For example, just now going back to the descriptions, right? So meaning is like a sale of the capital asset. Let's say it's the unlisted shares for domestics, right? So what are that's the disposal considerations. So on the left box, disposal considerations is contained under the section 65E, which is less incidental cost, less cost of enhancing, preserving the value of asset, and less cost of establishing, preserving, or defending title or right over the asset. And what is the acquisition price? So acquisition price is the price when you first acquired the shares. So these are the considerations. So plus incidental costs, less the compensations, damage or injury to asset, destructions, less insurance of any kind of damage, destructions or depreciations, and deposit forfeited on an intended transfer. If you see from the left box and the middle box, the similarity is on the incidental costs. So what is incidental cost here? So incidental cost is the cost of fee, commissions, for the professional service, or any failure by accountant or legal advisor, stamp duty costs, and then in case of acquisitions is the cost of advertising to find a seller, and in case of disposal is the advertising to find a buyer and cost of valuations for the market value. Okay, next slide, please. Okay, the use of market value. So the law is actually requires to use the market value as disposal or acquisitions. So what do you mean by market value here? Market value is actually you can determine by using a share valuation method. So what has been provided in the CGT guideline is that the net tangible asset per the audited financial statement. So net tangible asset per AFS is the total asset minus intangible asset and total liabilities lah. So that's how you do the market value. So there are three conditions here. The first box on the left side, which is the blue color one, the acquisitions or disposal of a capital asset shall be equal to the market value, meaning these are the conditions, right? So by way of give, when the disposed cannot be valued, or the transfer of the business is a lump sum considerations, and it's the transactions between a connected person or a related party within the groups. And in the middle box, so the DG, the Director General, they have the power to determine the market value. If the parties of the disposal are unable to agree on the market value, and if there is only one party to the disposal and DG is in the opinion that the market value agreed by the parties are incorrect. And the last conditions is when an asset is disposed of by being exchanged for another asset. So they are not able to agree on the market value and there is only one party to the disposal and DG is of the opinion that the market value agreed are incorrect. I have a case study in the next slide to show the example for the use of market value. Okay. So in the background, Fairness Sdn Bhd owns 7 million units of unlisted shares of Mercury at RM2 per unit. Right? On the left box there in the illustrations. And Fairness entered into an exchange agreement with Neptune Sdn Bhd to transfer all shares of Mercury to Neptune in return for a Neptune transferring a plot of land in Cyber 8 worth 15 million and a Tesla car worth 450K, sorry. So first thing first, what we need to see. Just now I mentioned about the date of disposal, right? The date of the exchange agreements. Yeah, I mean, I don't put the specific date here, but it's the date of exchange agreement. And what is the consideration value? So the consideration value, which is the market value of the land and the car itself. which is 15 million, plus the car for 50K. So yeah, 15 for 50 million is the considerations for the disposal for the exchange in terms of the shares. Okay, next slide, please. Okay, these are other computational provisions. So the gains or profits from the disposal of capital asset, it must be assessed separately and treated as a separate source of income. So for domestic shares, domestic CGTs specifically, like Yen mentioned earlier, yeah, it has to be assessed separately, and then you need to file the prescribed form for CGT 60 days upon the disposal date. And then the second consideration is capital asset that you're taking into trading stock. It will be deemed as a disposal. And the consideration is at the market value when the date is taken into the trading stock. Okay. So just now the disposal definition is also including a capital asset when they are transferred into a trading stock. Okay. If you have a loss on the disposal of capital asset, it can be set off against the subsequent gain on the disposal of other capital asset in the same year of assessment or in the subsequent 10 years of assessment. And then the amount of adjusted income is treated as a chargeable income from the source of gains or profit from the disposal of capital asset. Okay, next slide, please. Okay, so the next slide I'll discuss about the CGT exemptions. So this is the CGT exemption for domestic source. So it will be given on the disposal of shares related to IPO approved by Bursa Malaysia, intragroup restructuring, and venture capital companies. Okay, next slide. For foreign source, this is a bit tricky. So if you recall, foreign source CGT is actually for disposal of capital asset located outside of Malaysia, foreign capital asset. So this foreign capital asset can be the movable, immovable one, right? So movable is like a PPE, motor vehicle, even painting, and then the immovable one is a land and building located outside Malaysia. And they have to meet the certain, they have to be subject to CGT when the money is remitted to Malaysia. So they can qualify for CGT exemptions if they meet the economic substance requirement. So there are two economic substance requirements here. First thing first, they have to employ an adequate number of employees. And the second condition is they have to have an adequate amount of operating expenditure. So number of employee and operating expenditure here, there is no specific definition on how much to be qualified for economic substance requirement here. And it's very subjective. It just mentions that to carry out a specific economic activity in Malaysia, right? So the guideline on even the law does not really like provide further clarifications on this. But the factors that you can consider is what are the type of business activity of the company? Is it a labor incentive or is it capital incentive industries? And whether the company employees works full-time or part-time, and whether the office premises have been used to carry out related activities are sufficient for those activities. So the exemptions for this foreign source CGT is from 1st of Jan 2024 to 31st December 2026. So we have another 2 years for this. Okay, next slide. Okay, this is for any gains or profit from the disposal of IP, intellectual property rights, will be excluded from the CGT exemptions in case where the taxable person, which is the four category of taxpayer, right? Company, LLP, trust body, or cooperative society is the owner of or licensee of the IP rights. Meaning that if the owner of licensee of the IP, they are subject to CGT for this case. And then IP rights, meaning rights arising from patent, utility, innovations, and blah blah blah. I think you can see from the slide here. And it's not applications for certain businesses, so it's not like the exemptions order will not apply for person carrying out business of banking, insurance, sea transport, or air transport. All right. The next slide we'll talk about the double tax agreement, and my colleague Priya will talk about that. Thank you.
Kartika. All right, so I will just very quickly, in 5 minutes or less, go through double tax agreements in the context of capital gains tax. So in the context of a double tax agreement, the capital gains here refers to the taxing of the gains that are of a capital nature, and when they involve residents of two countries that have a tax treaty with each other. So the first thing that you would need to look at here is the residency status. So it's important because most tax treaties allocate the taxing right based on residency. So depending on the tax treaty, the taxing right could be allocated to the source state, meaning where the asset is, so where the capital gain is sourced, or the resident country, so the country of the alienator. So some tax treaties then also provide maybe certain preferential rates for gains that are of a capital nature. And then comes the question, of course, of double taxation. So can a tax treaty provide any protection from double taxation? Main purpose of the tax treaty, of course, is to prevent double taxation. So the tax treaties will usually provide some kind of mechanism, for example, a credit mechanism or an exemption, or maybe some kind of a deduction to ensure that the taxpayer, that you as a taxpayer, you don't end up paying tax on the same income in two different countries. So it's important here to actually review the wording of each of the tax treaties to assess the appropriate precision. Here we have an example of the taxing rights on the slide based on the Article 13 of the OECD Model Tax Convention. I won't go into the particular details here, but let's move on to the next slide where we can look at some case studies. So let's look at the first case study, which is on the left. So in these two case studies, we're looking at disposals where Malaysia is the source country, meaning Malaysia is the country where the asset is. So in the first case study, we have the UK Co, which is disposing of its shares in DE Co, which is in Germany. And DE Co holds shares in A. Sdn Bhd. A. Sdn Bhd has 40% of its total assets, which is real property. So when we look at para 4 of the OECD, Article 13 of the Model Convention, it says that gains that are derived by a resident of a contracting state from the alienation of shares may be taxed in the other contracting state if at any time during the 1-year period, so 365 days preceding the alienation of the shares, more than 50% of their value, directly or indirectly from immovable properties, is situated in that other state. So since the value of this immovable property is 40%, so it's less than 50%, then we look at para 5 instead, which states that the gains from the alienation of any property other than that referred to in the preceding paragraphs shall only be taxable in the contracting state of which the alienator is resident. The key point here is shall be taxable only in the contracting state of which the alienator is resident, which then therefore gives the taxing right to the resident country, which is the UK in this case. And so the disposal of DE Co shares will be taxable in the UK. And now we move on to the second case study, which is on the right here, which is similar situation here, except that now A. Sdn Bhd has 60% of its total assets as real property. So we apply then para 4, which then therefore gives the taxing right to Malaysia. And therefore the capital gains tax on the disposal of the shares in SG Co will be applicable in Malaysia. Next slide. And let's look at two more case studies here just before we wrap up. In this case, we're looking at Malaysia being the resident country. So simple one here on the left, A. Sendirian Berhad holds real property, which is in a different country, which A. Sendirian Berhad is going to dispose of. In this case, we look at para 1 of the Article 13 of the OECD Model Convention, which states that gains that are derived by a resident of a contracting state from the alienation of immovable property and situated in the other contracting state may be taxed in that other state. That means that the gains derived from the alienation of gains derived by A. Sendirian Berhad from the alienation of immovable property that is situated in another state may be taxed in the other state. That means the taxing right here is of the source country, meaning where the real property is situated. And then lastly, on the right here, we have another example. So in this case, we have A. Sendirian Berhad that is disposing of its shares in a UK company. And UK Co holds real property, which is 100% of its total assets. And here again, we look back again on para 4 of Article 13. And in this case, the source country, which is the UK, will have the taxing rights. But however, under Section 15C, which my colleague Yen spoke about earlier, under 15C, it will be deemed to be derived from Malaysia if the value of the total tangible assets is more than 75% of real, is 75%, sorry, total tangible is more than 75% real property. So in that case, the taxing right will be preserved in Malaysia. So if there is any double taxation in this case, there will need to be a form of credit mechanism or an exemption of some sort so that there is no double taxation. So when you actually have cross-border disposals, it's important here to really understand the difference between the source state and the resident state, first of all, and then the country which has the taxing right. And it's important to look into the domestic law as well as the double tax treaty to see who has the taxing right and who which law prevails at the end of the day. And then if there is a double taxation, how a double taxation can be mitigated by way of credit or exemption. And more importantly, it's to understand that there are differences in different tax treaties. What I've discussed here is talking about the OECD Model Convention, and specific tax treaties could have specific nuances and certain differences. So you have to look into each treaty and assess that depending on each situation. All right, so that's it. So next slide, I think we have some references. Yeah, so on this slide here, you'll just see that we have put on some resources that you can refer to, which gives an overview and what the guidelines are and some more details on how capital gains tax is going to be implemented. Right, so that's all for the presentation today. I think we can take some questions.
So thank you very much, everybody, for this huge amount of information and details on the newly implemented CGT in Malaysia. And actually, we do have questions. Of course, I think there probably is still more, but it takes a little bit of time to digest all that's been coming in the past hour. So I can just start with the first one, which is, will a redemption of redeemable preferences shares fall within the ambit of CGT? We seem to have a little audio problem here.
Hi, Bettina. Yen here.
Yen, okay.
Yeah. Okay. So will redemption of redeemable preference share fall within the ambit of CGT. Yeah. So I think we still, for this, we need to go back to see the scope of the CGT, because and also specifically the definition of disposal, whether it falls under the definition of disposal, and also the definition of shares, whether it covers the redemption of preference shares. So if it is covered under the scope of CGT, the ambit of CGT, then it will be subject to CGT in Malaysia.
Let me just add another point here. So I think when we look at redeemable preference shares, I think we look back also at the definition of capital asset, which says that it includes movable properties situated in Malaysia, which is a share of a company that is not listed on the stock exchange, which also includes any rights or interests thereof. So I think when we look at redeemable preference shares, even though it is not outrightly shares, there is some form of interest or right attached to a redeemable preference shares. And also an interesting point that should be taken note of is that redeemable preference shares in general by the Malaysian tax perspective is viewed as equity. So there is a likelihood here, I would say, that RPS would fall within the scope of CGT.
Thank you very much. I hope this answers the question. It was a very elaborate answer. I hope it helps. If a Malaysian company disposes shares in a company incorporated outside Malaysia, will it be subject to CGT? Then I think this is one more for you.
Okay, so like I mentioned earlier, so if there's any shares of a foreign company, so we first need to see whether it falls within the ambit of Section 15C, whether it's deemed derived in Malaysia. So for that, we need to see whether the defined value, whether they own real property and whether they pass the 75% defined value test. Otherwise, if it doesn't fall under the 75% rule, then any disposal of shares in a foreign company will only be taxed in Malaysia when it's received in Malaysia. It will still cover under the CGT, but it will only be taxed upon the remittance into Malaysia. So we need to differentiate whether is it a domestic source CGT or a foreign source CGT. For any disposal of shares in foreign companies.
Thank you very much. We go on with the next question. What is the impact of CGT on unit trusts and latest development on CGT and foreign sourced income for unit trusts? I think, Kartika, this is your turf.
The latest update is on 16 January, right? I think that time the finance minister actually they have announced that the exemptions will be given for unit trusts for CGT. I think it was mentioned in the slides just now. That and income tax on remittance of FSI. So I mean they still want to encourage individuals to continue investing in unit trust fund. So but just bear in mind that these exemptions is because the exemptions are given for specific exemptions period, which is in 1st of January 2024 to 31st December 2028 for CGT, but I think it's for 1st of January 2024 to 31st December 2026 for FSI for unit trusts.
Thank you very much. This is another one. When does a company need to report its CGT?
Okay, Yen here, so I will take this question. If it's a domestic source, then it will be within 16 days from the date of disposal. If it's a foreign source, it will be together with the corporate income tax return whenever the foreign gain is remitted into Malaysia.
Thank you very much. Another one. The definition of disposal includes a reduction of share capital. How to interpret this in a situation of capital reduction exercise where there is no buyer and seller per se? Probably from Kartika.
Okay, I'll take this. Yeah, it's a good question. So, yeah, so the disposal just now I mentioned, I think I highlighted that it's include capital reductions for shares, right? So, yeah, it's correct that capital reduction exercise, it has no buyer and no seller per se. So it's merely just a return on capital for the shareholders by extinguishing the company shares. So on this type of transactions, I mean, it has been included as part of disposal definitions. So what I can say is just effective taxpayer need to be aware of the obligations to file the CGT returns when they implement this capital reduction exercise. But in terms of the details on how what is the mechanism and all, there is no specific guidelines issued by the government.
Thank you very much. Just a second, I have to get on with more of our questions. They keep coming in. This is great. Thank you very much for being such an active audience. I'm just having to get all this sorted. So let's continue with the next one. Will there be double taxation between CGT and RPGT?
Hi, Bettina. Okay, I will take this one. Yeah, I think a lot of people are worried about the double taxation, covered under RPGT or CGT. So it is already clear, and the legislation has already been amended that there is actually no double taxation between RPGT and CGT. So CGT is only applicable on that 4 group of taxpayer and only specific for that disposal of capital assets as defined, and RPGT is only applicable on the land situated in Malaysia and shares in real property companies. So it is clear that there is no double taxation, and CGT and RPGT are mutually exclusive here.
Thank you very much. And I have another question. I think it refers to the first question I handed in regarding the redemption of redeemable preferences shares. And the explanation you gave. Does it mean that if I keep the gains in an offshore bank account and do not remit, it will not be subject to CGT?
This goes back to the foreign source, whether the gain is domestic source or foreign source. So yes, if it's foreign source, and if you do not remit, then it will be considered as foreign source income that is not remitted, and it won't be subject to tax until you remit.
Okay. Well, that was a very precise answer to this. So, and as far as I can see, we have answered all questions coming in so far. Of course, if there are more questions coming up later after digesting all the information and the input that has been delivered this morning, we will, or afternoon for you, we will of course be happy to liaise and get back to all that comes up in a bilateral way. And like always, it will also be my pleasure to share the slide deck with you. As I said, you will also be receiving the link to the recording of this webinar. So I hope there will be all chances to recap on whatever issues are coming up. And like I said, we will be open to any form of contact to get back to you and assist with whatever comes up. Please accept my sincere apologies for the technical issues we experienced in the beginning of this webinar. I'm happy we solved this. So even if we didn't have the pleasure to see Yen all the time, we were lucky enough to listen to her, which was a great thing to have. Thank you very much. Thank you all for attending and participating so lively in this webinar. Well, and as I said, come back to us for any further information you might require. We will be happy to attend to whatever comes up, and hoping to see you soon. Take care and goodbye.